You worked your whole life. You paid your taxes. You put money into the system. You saved what you could, and you're counting on the government benefits to be there when you retire, right? You're looking forward to seeing those old age security payments hit your bank account. But what if I told you there's a hidden government rule, a sneaky tax trap that could systemically slash those payments or maybe even wipe them out completely? For hundreds of thousands or maybe even millions of Canadian retirees, this isn't some bad dream. It's a shocking reality. It's called the Old Age Security Recovery Tax, and you probably know it by its nickname, the OAS clawback. And it does exactly what it sounds like. It claws back the benefits you thought were a sure thing. So in this video, we're going to break down exactly what this trap is, how it works, and most importantly, I'm going to give you a clear step-by-step withdrawal plan and several proven strategies you can use to protect your benefits. Sidestep this trap and keep the retirement income that you rightfully deserve. Hi guys, I'm Manu and welcome to another episode of Sweet Money. I'm a Canadian and US CPA with a cool little accounting firm better known as Shandel CPA. So what is this sneaky tax trap? Officially, it's called the Pension Recovery Tax, right? It's almost like a swear word. Really, it's the government's way of cutting the OAS payments for seniors who have a higher income. Think of it like this. The government gives you OAS as a foundation for retirement. But if your income from other places start to pass a certain point, they start taking some of that foundation back. Here's how it works. For the income year 2025, the magic number, the income threshold where the clawback kicks in is $93,454. This is your net income. The number on line 23,400 of your personal tax return. And for every single dollar you earn over the threshold, the government claws back 15 cents from the OAS benefits. Let's make this a real quick example. Let's say your net income for the year is $103,454, right? That means you're $10,000 over the threshold. So that 15% rule is $1,500 of your OAS will be clawed back. This means they'll chop your total OAS payments for the year by $1,500, and the more you make, the more they take. And the clawback keeps going until your income hits a second, much higher threshold, and at that point, your entire OAS pension for the year is gone. For 2025, that full repayment threshold is around $151,668. And this is applicable to folks between the ages of 65 and 74. Imagine planning your retirement budget around you getting the maximum OAS benefit of roughly $8,800, only to find out you don't get the amount because you poorly planned for how you extracted your cash during your retirement years. For those 75 and over, they lose their OAS benefit at $157,490. There you have it, my friend. That's the trap. But the good news is, with a smart plan, you can work around it. All right. Let's get into the solutions. Protecting your OAS isn't about earning less. It's about being smarter with how and when you take your income. I'm going to walk you through 6 powerful strategies, starting with the most important one, the order in which you withdraw your money. This is the absolute cornerstone of a tax-smart retirement and your best defense against the clawback. The order you pull your money from different accounts, your RSPs, your TFSAs, your non-registered accounts, makes a huge difference on your net income. So, what's the best order? For most people, it looks like this. First, pull from your non-registered accounts. These are your normal investment accounts. You start here because the income they generate is generally taxed in a friendlier way. For example, only 50% of capital gains is taxable, which is better than your RSP income, which is taxed at 100%. By taking your non-registered money first, you keep your official taxable net income lower while still getting the cash you need. Then, number two, you draw from your RRSPs or your RIFs. This is the money that gets fully taxed as income. The key here is to be strategic. You want to start dipping into these accounts before the government forces you to. Lots of people wait until they're 72 and the mandatory RIF withdrawals kick in. Then on top of that, you throw in your CBP and your OAS, and it can easily shove your income above the threshold. If you can draw down your RSP or your RIF earlier in your retirement, say in your 60s, you can then take out smaller chunks of money, smooth out your income, and strategize so that you remain below the clawback threshold. Third and last, this is when you touch your tax-free savings account, your TFSA. This is your secret weapon. This is the ultimate shield against the clawback because any money you withdraw is completely tax-free. It doesn't count as income. It doesn't show up on your tax return. It's totally invisible to the OAS clawback calculation. This account should be the last one you draw from because letting it grow tax-free for as long as possible while giving you the source of cash that you need will never put your OAS at risk. Your RIF can be your best friend or your worst enemy when it comes to the clawback. Like I mentioned, you're forced to start taking minimum withdrawals after the age of 71. These withdrawals are fully taxable and the main driver of an OAS clawback. But you have control. First, if you're married or have a common law partner, you can base the minimum withdrawal amounts on the age of the younger spouse. This means a smaller withdrawal requirement each year, which leaves more money in the RIF to grow tax deferred and more importantly, lowers your taxable income for that year. Second, think about starting RIF withdrawals before you have to. If you retire at 62 and you have a few lower income years before you start taking your CBP and OAS, well, that's a golden opportunity. You can start pulling money out of your RRSP at a much lower tax rate, effectively melting down the account to shrink the balance before those mandatory withdrawals get much bigger. Guys, about 61% of my viewers are regularly watching my videos, but still haven't smashed that subscribe button. It won't cost you a penny, but it provides the fuel that I need to help me keep going. Most importantly, this helps spread vital information to our fellow Canadians. So give me some SLC. SLC is subscribe, like, and comment. This is one of the most effective and often overlooked strategies for couples. If you're 65 or older, the Canadian tax law allows you to split up to 50% of your eligible pension income with your spouse or your common law partner. This includes payments from a company pension plan and yes, your RIFs. How does this help? Imagine one spouse has income of $110,000, primarily from RIFs and a few other sources, right? And it puts them deep into the clawback zone. And the partner is earning $30,000. Right? Now, by splitting the maximum, which is 50%, and let's just say that 50% is $20,000, you can now reduce that $110,000 of taxable income to $90,000, and that $30,000 will jump up to $50,000. Not only have you saved on your taxes by splitting the income, but you have also received the full OAS amount. I've already mentioned the TFSA, but it deserves its own strategy because it's that powerful. Every dollar you withdraw from your TFSA is 100% tax free and has zero impact on your OAS benefits. This makes it the perfect nest to keep money for those big one-off expenses, such as repairs, that dream vacation, or that car you've always wanted. However, pulling that same amount of money from your RIF can create a major spike in your income, perhaps even wiping out your entire OAS benefit. Therefore, for all you working Canadians out there, your goal throughout your working years is to maximize your TFSA contributions. And even in retirement, if you have a year where you have to take a large RIF withdrawal, but you don't need all that money and you have room in your TFSA, plug some of that money into your TFSA. Now, this is a more advanced strategy and it requires some careful planning. So please consult with your accountant and your portfolio manager. You have the option to delay your CPP and OAS benefits. For every month you put off or you delay the OAS benefit from the age of 65 to 70, your benefit increases by 0.6% each month for a boost of 36% over that 5-year window. Delaying can be a powerful anti-clawback move. By deferring OAS and CPP, you can create a window of several years in your 60s in which your income is naturally lower and allows you to extract more money from your RRSPs. So you get the money out of a fully taxable account before your guaranteed government benefits begin. And then when you do start the OAS at the age of 70, not only is your payment bigger, but your RIF balance is smaller. This means your mandatory withdrawals will be lower and less likely to trigger an OAS clawback. Finally, for your non-registered investment accounts, what you invest in really matters, okay? Remember, the clawback is based on net income and not all investments are taxed at the same rate. For example, interest income is 100% taxable. Eligible Canadian dividends get grossed out, which means you actually have to report a higher income than the actual cash you received, which can speed up the OAS clawback. Capital gains, however, are your friend. Only 50% of capital gains get added to your taxable income. So focusing on growth-oriented investments as opposed to high interest rate GICs or dividend-paying stocks is not the right strategy. Another key tip is to cash in your large capital gains before the government benefits kick in. And if you have investment properties, that's another layer of complexity which you should discuss with your accountant before you retire. The old age security clawback feels like a penalty for being a good saver, but it doesn't have to be that way. It's a problem with a clear solution. It's not about luck, it's about structure. The key is to be proactive. Manage your retirement income with a deliberate plan. Draw from your non-registered accounts first, and then strategically pull money out of your RRSPs or RIFs, and then finally you dip into your TFSAs. Leveraging income splitting with your spouse is key, and with proper strategy, you can manage your RIF withdrawals later on in life in order to keep them low and use your TFSA as the ultimate clawback shield. Creating a personalized withdrawal plan before you retire is one of the most important things you can do to maximize your after-tax income. The rules might be sneaky, but with these strategies, you're now equipped to navigate the trap. And you have to make sure your hard-earned retirement income stays where it belongs, and that's with you. And look, if you're not sure how these strategies apply to you, reach out to your accountant, reach out to your portfolio manager and build a plan that's right for you. And remember, it all starts with a simple conversation.